A stock does not fall 31% in a single trading session because of bad vibes. That kind of move, wiping out roughly 1/3 of a company's entire market capitalization in hours, requires a specific structural trigger. StoneX Group, ticker SNEX, just did exactly that in July 2026, and the reason matters far beyond this one company. Here is the real question. Was this a justified repricing of genuine risk? Or did the market just hand it a certain type of investor a window they have not seen in years? Stay with us. The answer depends entirely on what kind of business StoneX actually runs. Before you can evaluate a 31% drop, you need a clear picture of what you are actually looking at. StoneX Group is not a bank in the traditional sense, and it is not a straightforward brokerage. It operates as a financial services network, a global intermediary that moves capital across commodity markets, foreign exchange desks, securities clearing, and payments infrastructure for institutional clients, commercial hedgers, and independent introducing brokers. Think of it as the plumbing behind a significant portion of the mid-market financial world. That sounds stable. It is not inherently stable. The business model of a financial intermediary lives and dies on two things: counterparty trust and balance sheet velocity. StoneX posts client margin, facilitates trades, and earns spread and fee revenue on enormous notional volumes. The key word there is notional. The company routinely moves billions in notional exposure while working on relatively thin net margins. In fiscal year 2025, StoneX reported operating revenues of approximately $3.3 billion, but net income attributable to common shareholders came in around $200 million, a margin structure that leaves very little room for unexpected losses or liability events before the equity story breaks down entirely. This is the architecture that makes intermediary stocks so dangerous when something goes wrong. A 1% disruption in a business, managing hundreds of billions in notional volume, does not translate to a 1% loss. It can translate to an existential event at the equity layer. That is the fragility built into the model. And it is exactly why this kind of stock can reprice 30% in a session while the broader market barely flinches. The actionable lesson here is foundational. Always size your exposure to financial intermediaries in proportion to how well you understand their off-balance sheet obligations. A drop of this magnitude on heavy volume in July 2024 does not happen in a vacuum. The market is telling you something specific, and your job is to read what it is actually saying, rather than what the fear suggests. For a company structured like StoneX, the categories of catalysts that produce a one-day 31% move are narrow. They typically fall into one of four buckets: a significant unexpected loss event tied to client defaults or counterparty exposure, a regulatory or legal action that threatens the operating license or imposes material liability, a disclosed accounting irregularity that calls prior earnings into question, or a sudden liquidity stress signal, such as a credit facility being drawn, suspended, or renegotiated under pressure. What you do not see with a move this large is a simple earnings miss. A 5 to 10% drop is an earnings miss. 31% is a structural credibility event. The heavy volume accompanying the move is equally significant. When volume surges alongside a drop of this scale, it signals institutional exit, meaning the investors with the deepest access to management and balance sheet data are the ones selling. Retail money does not drive that kind of volume in a mid-cap financial stock. That is sophisticated capital re-rating the risk. Now here is the analytical discipline that separates sharp investors from reactive ones. The size of the move does not automatically confirm the severity of the problem. Markets overshoot. Financial stocks are particularly prone to reflexivity. Fear of contagion spreads before the facts do. The actionable framework is this: do not buy or sell this event on day one. Wait for the company's official disclosure or investor call. Isolate whether the trigger is a one-time loss or a repeating structural flaw, and only then assess whether the new price is compensating you adequately for the risk. Reacting before that clarity arrives is how retail investors absorb institutional panic at the worst possible price. This is the question that actually matters, and the honest answer is, it depends on a variable most people will not know for 48 to 72 hours. Here is how to think through it rigorously. Before today's crash, SNEX traded at a price-to-earnings multiple that reflected the company's consistent history of profitability in a specialized niche with meaningful barriers to entry. StoneX has real competitive advantages: its global network of clearing relationships, its regulatory licenses across multiple jurisdictions, and its entrenched position with commercial hedgers who have high switching costs. These are durable assets. A 31% repricing now implies one of two things. Either the market believes those assets are impaired, that future earnings will be materially lower, or it believes there is tail risk, meaning a scenario where the losses are severe enough to threaten the equity entirely. The way you evaluate which scenario you are in requires looking at three specific data points as they emerge. First, the size of the disclosed loss or liability relative to tangible book value. If StoneX's tangible book per share sits in a range that still provides meaningful coverage above the new share price, the sell-off may be an overreaction. Second, whether management responds with buybacks, debt drawdowns, or silence. Silence is the most dangerous signal. Third, whether credit markets reprice StoneX's debt alongside the equity. If bonds hold relatively stable, while the stock craters, that is often a sign that equity holders are being spooked by a recoverable event rather than a solvency-level threat. For beginners watching this unfold, this is not financial advice, and a stock down 31% is not automatically a buying opportunity. It is a lesson in what risk concentration inside a leveraged financial intermediary actually looks like in real time. The most important skill you can build from watching this is the discipline to evaluate without emotion, wait for disclosure, and never confuse a low price with a good price. Price and value are not the same variable. They converge, but rarely on the same day. So here is where we land. StoneX fell 31% because financial intermediaries carry structural fragility that only becomes visible under stress. Whether the move is justified depends on disclosures still coming. The open question we started with, overreaction or accurate repricing, now has a framework for your answer. Next video, we examine the broader pattern of mid-cap financial stocks that flash these exact warning signs before large moves. If that is useful to you, subscribe to Synthetic Alpha. Like this video if the breakdown was worth your time.